So the third method of investment appraisal is the use of net present value, which is the same as discounted cash flow. So how do we use net present value? Yeah, I wrote this is the present value of future incomes from an investment project minus your cost. So the present value of the investment you have done, the present value of it, you take it away from the cost. That means the initial cost of that investment. So most of the time, they use this to be able to know the time value or the money value of this present time. So if I'm investing $100, example, if I'm investing $100 at this point, what is the value of this $100? What will it be in the next 3-4 years? So it puts into consideration the time value of the money you are investing. So here I wrote, both payback and ARR methods do not take into account the time value of money, meaning putting into consideration the present value. So for investment appraisal, using average rate of return or using payback period, they don't give you the present value of money. That means the time value of money they don't give you. They only tell you what your return on investment will be. Do you get the point here? But with net present value, it tells you the value of that money now, the worth of that money now, and what it should worth in the nearest future. Basically, you use compound interest. So now I made, for example, and said, what is $100 worth of investment? What is $100 worth of investment? Worth of investment be in the next 5 years with a compound interest of 10%. So here you have to calculate using the compound interest. So they said the next 5 years. So this method is put into consideration the worth of $100 now to the next 5 years. So whatever it's going to give us the next 5 years, it must be true that the $100, the worth of $100 today would be the result we're going to get at the end of 5 years. So if the worth of $100 today, if the worth of $100 will be $250 in the next 5 years. So what it means is that whatever $100 investment is worth today must be $250 in the next 5 years. So how do we calculate this? Here the question is, what is $100 worth of investment be in the next 5 years with a compound interest of $10? So we start with the year one. For year one, we said the compound interest is 10%. So 10% is the same as 0.1. So you use your normal compound interest, the principal, that's the amount, the initial amount, which is $100, into, you open a bracket, 1 plus 10% to the numbers of years. You get it? So 100 plus, that means CI equals to principal plus, open bracket, 1 plus 10, the rate, that's R over 100 to the power of 1. So year one, we have 100 into 1 plus 10 divided by 100 is 0.1. So 0.1 plus 1 gives us 1.1. So 1.1 times to the power of 1 multiplied by 100 gives us 110. So in the first year, in the first year, $100 will worth $110. So that means 10%. The second year two, 100 into the bracket again, you open the bracket, 1 plus 0.1, you close the bracket to the power of 2. So we have 0.1 plus 1 gives us 1.1. So 1.1 times 1.1 gives us 1.21. You multiply by 100, gives us 121. So in the next 2 years, the $100 of today would be worth 121. Same goes to the third year, to the fourth year, and to the fifth year. We need the fifth year, which is, so for the fifth year, we have $100 into the, open the bracket again, 1 plus 0.1, you close the bracket to the power of 5. So that means 1.1 multiplied by 1.1 multiplied by 1.1 multiplied by 1.1 multiplied by 1.1. It gives us 1.611. So you multiply it by 100, then you have 161. So it must be true that at the end of 5 years, the $100 of today must have worth 161. That is when you use the NPV. So you want to understand the present value of money to what happens in the nearest future. Is that clear? So I have the table. The table is drawn already, but how they calculated it, I've worked it out here. So based on this analysis, when considering the time value of money, it must be true that $100 today must equivalent to 161 in the next 5 years, which I already explained. I think it's clear.
Yes.
Okay. Now, how do we calculate the net present value? To calculate the net present value, it is the present values minus the initial cost. So the present value of money of that investment minus the cost of that investment. So how do you get the present value? You get it through the cash flow for each year. So I think it's clear, right? Okay. So here we have an analysis here. Look at the rate of discount. Scroll down, please. Okay, let's see. Yeah, a project is used here. We have project A, project B, project C, using the NPV. So how do you calculate your NPV using these when you have to compare these projects? So what you need to do is, for each project, like project A, the initial cost for project A is 50,000. Are you with me?
Yes.
Then, if the initial cost of the project is 50,000, it is on negative because that's an investment, right?
Yes.
So you calculate each net cash flow. Year one has 8,300. So we have 8,000. So year one has 8,300 plus 6,900. Are you there, please?
Yes, sir.
Plus 5,800 plus 4,800 plus 4,000 plus 3,300 plus 2,800 plus 2,300 plus 1,900 plus 1,600. So we have 41,700. Did you get it there?
Yes.
So for project A, yeah, it's 41,700. So the present value for project A is 41,700. Then we said NPV is present values, which is 41,700, minus the initial cost, which is 50,000. So 41,700 minus 50,000 gives a negative of $8,300. So this project is going to be running at a loss. So you need to check other projects to compare and contrast. I think it's clear how you get it now.
Yeah.
You have to calculate the cash flow for each year. You minus it from the initial cost. That is how you get your net present value. Any question about that?
No.
I think it's clear, right?
Yeah.
So that's the 8,300. That's the NPV. It's written at the bottom. The initial cost minus the present value, which you have to get through the cash flow.
Okay.
I think it's clear.
Yes.
So look at project B. Initial cost, when you take 50,000 from 42,000, you got a negative answer to. Then project C, it has a present value of 58,260, which is more than the cost. So that means project C will be suitable. It's profitable to invest in project C.
Mm-hmm.
I think it's clear.
Yes.
All right. So what are the advantages of discounted cash flow method? What makes it better? What are the importance of it? Number one, the discounted cash flow method correctly accounts for the value of future earnings by calculating the present values, unlike the payback or the ARR. So what we are saying here is this: when you use the net present value, it calculates the present value of money, unlike the ARR, which we only told you about the return on your investment. Unlike the payback, which will only tell you the amount you have to, the period you have to use to pay back that amount you've initially invested.
Mm-hmm.
I think you get the point here.
Yeah.
The NPV allows you to calculate the values of money in the present day, unlike the payback and the ARR. Two, the discount rate used can be changed as risk and conditions in financial market change. So what they're saying here is you can change the method you use here. The good thing about the discount rate the discount rate method is that you can change it based on the financial situation, the market situation. So if $100 today, when you save $100 in the market today, if the interest rate in the market has increased to maybe 20%. So if you want to calculate your NPV, you have to use the compound interest of 20%. That is what they're talking about here. So it's flexible that you can change the rate to the present, to the market situation. That means to the financial market situation. It is flexible to change. Do you get it?
Yeah.
Do you understand what you're saying here? The first advantage is that it measures the value of your future earnings, what you would make in the future. Unlike ARR and payback, they only talk about the return on your investment, the period you have to make, the period you have to reach before you can realize the amount, you can get the amount of money you invested at cost. That is what payback period does. And for the average rate of return, the ARR, it tells you, it gives you the number of years that you will pay back.
Yeah.
But for the NPV, it tells you, it gives you the value of what you could earn in the future. And the second one is that the discounted rate method, it's flexible to the extent that whatever the financial market rate is, or the market situation is, you can adjust that method to that situation. So if the interest rate in the market, if the interest rate in the financial sector or in the financial institution is 5%, you can use your compound interest to be 5%.
Okay.
Then what are the limitations of? That's about the advantages. So go to the limitations of these techniques. So for the limitations of these techniques, for the payback, what are the problems? What are the problems using the payback period? Number one, cash earned after the payback period is ignored. You know, when you use the payback period, we only want to reach that point. Are you with me, please?
Yes.
We only want to reach the point at which we'll be able to pay back that amount of money we have invested in the business. Afterwards, we don't care. That's why we say, oh, are we going to be able to pay back in the next 2 years, or it's going to take us 3 years to pay back? Oh, it's 3 years, that's done. That is all it does. It does not care. It does not care about what happens when you have paid back the initial cost. That means the capital cost. When you have paid it back, it doesn't care. So that is a problem. But because you have to put into consideration also what you make after paying back the initial cost.
Mm-hmm.
2, the profitability of the methods is overlooked. Whatever you're going to make profit, definitely, but profit is not stated yet. Profit is undermined here. Nobody talks about profit. We only think about the payback time. When are we going to be able to pay back this amount of money? That's all. So if the project is going to be profitable or not, we don't care. We see it as profitable in as much as it takes a shorter period of time to pay back. But that is not profitability. Do you get the point here?
Yes.
Great. That's about payback. Then we go to the average rate of return, ARR. The only problem about ARR is that the effect of time on the value of money is ignored, unlike the NPV. NPV will tell you what the future earnings are, but the ARR, the average rate of return, does not tell you the time value or the money value of this period. It does not. It only tells you the average rate of return, when the lowest time you'll be able to pay back. Do you get the point here?
Yeah.
Which is a problem. We need to know what $100 will worth in the next 5 years. So if we are investing $100 now, it's not just going to be like in the next 10 months or in the next 2 years, we'll be able to realize $100. No. What will $100 be? The worth of $100 today, what will it be in the next 5 years? This is the advantage it has, the NPV has over other investment appraisals. And for discounted cash flow, they said the calculation is more complex than other methods. Yes, it's more complex. Unlike the average rate of return, which is the amount of money divided by the cost, you get the value, the year. And for the payback period, you just have to know the amounts you have to put into the business, the years that you have to pay back. And if you have other years to pay from, other months to pay from, you deduct it from the initial cost. But for discounted cash flow, it is more complex because you have to calculate first the present value now, and you have to understand each year's cash flow.
Yeah.
But for NP or for ARR, you have just a whole amount to take away from. But here you have to calculate all the cash inflow for each year to get the net present value. So you need to get the net present value, you need to take the present value from the cost. Any question about it?
No.
So that's all about initial, that's all about investment appraisal. Is it clear, or you want me to summarize it?
It's clear.
It's clear, okay. So logically, or basically, when you talk about investment appraisal, it means that you are evaluating your investment. So why are you evaluating your investment? You are evaluating your investment so that you can know if it is profitable or not profitable. If it is not profitable, you wouldn't even try to invest on it.
Yeah.
So that's the basic behind
Yeah.
investment appraisal. It's clear, right?
Mhm.
Okay.